Alright, in this video we're going to calculate the cash flows for a capital budgeting project. This is Shrieves Casting Company, and let's talk a little bit about what we have here. We've got an initial investment cost of $200,000. It'll cost $10,000 to ship this piece of equipment in, $30,000 to install it. And therefore the total amount of depreciable cost is the sum of the cost of the shipping and the installation and the initial cost of the equipment, or $240,000. That's what's required by tax law. Salvage value of this equipment at the end of the project is $25,000. We can sell the equipment for $25,000. Initially we're going to sell, well actually in this example we're going to have 1,250 units a year. The price of the units will be, the selling price will be $200 each. The production cost will be $100 each. The tax rate 40%. At the beginning of every year you have to have accounts receivable and inventory amounting to 12% of sales on hand, and actually this would be the amount less any accounts payable. So net operating working capital that must be on hand at the beginning of every year is 12% of the sales that will be, or you're expecting to make during that year. Weighted average cost of capital is 10%, and we have an inflation rate of 3%, which applies both to the unit selling price and the unit cost. All right, so the first thing we need to do is figure out what's going on with the equipment, which is to depreciate it. For our example, we're going to assume that we use modified accelerated cost recovery system 3-year depreciation, which is what you would use, not necessarily 3 years, but what the makers is what you would use for tax purposes. And so the annual depreciation charged in each year, and notice that a 3-year asset is depreciated over 4 years, a 5-year asset is depreciated over 6 years, etc. That's because of the half-year convention built into makers. But in any case, the depreciation is going to be our maker's depreciation rate, and we need to make that an absolute cell reference. So maker's depreciation rate times the, oops, that needs to be a relative cell reference, multiplied by the depreciable cost, or the basis, and that's the one that needs to be an absolute cell reference. And we just copy this baby over. And you notice we have $79,000, $106,000, $35,000, and $17,000 in years 1 through 4 of depreciation charges. Now we also have a book value, and we need to figure that out. The original book value is the depreciable base. The book value at the end of any year is the prior year's book value minus the depreciation that got charged. And so we just copy that over, and notice if you've done this correctly, your depreciation will go down to 0 at the end of the depreciation time period. Alright, now all we're going to do is we're going to create a little income statement, and we have 1,250 units sold. So we know how many we're going to sell each year. We don't have any growth in this case. The selling price is going to be $200 each initially, and then it's going to be 200 the prior year's selling price times 1 plus the inflation rate in each year. So we copy that over. So the total sales is simply the number that you've sold times the selling price. Alright, same thing with costs. Our unit costs start off at $100 each, and we inflate that by the inflation rate. You could conceivably have a different inflation rate for costs and for the selling price, and that happens frequently in medical practices, for example, as you get declining reimbursement but you have increasing costs. So your selling price actually might have not a positive growth rate but a negative growth rate, but your unit costs would have a positive growth rate potentially. Alright, so the total costs are the unit cost times the number that you've sold. And we've got a depreciation charge, which we've just calculated. And so that gives us profit before taxes, which is our total sales, minus the total costs, minus the depreciation. We have taxes on that, which are the profit before taxes times the assumed tax rate, which is 40%. We need to put an absolute cell reference on that 40%. And that gives us a net income of our profit before taxes minus the taxes, $27,000 in the first year, increasing to $71,000 in the final year. And of course, the reason it's increasing is because sales price is going up, even though costs are going up, and depreciation is going down. However, in this case, $27,000 is not the amount of money you have left in your pocket after the day is done. Rather, you have already experienced $79,000, almost $80,000 in depreciation expense, but that's not money that you have to pay out. It's a pretend expense. It's called a non-cash expense, and so we have to add that back in to figure out how much money is left in our pocket at day's end, and that's, in this case, $106,000 in the first year, declining to $89,000 in the final year. All right, so this is really important. You have to add back in depreciation. Now let's go to the net operating working capital. You have to have at the beginning of the year the 12% of sales. So we have sales multiplied by the next year's sales multiplied by our assumed 12%, which is right there in B13. So we need $30,000 on hand at the beginning of year 0. At the beginning of year 1 at the end of year 0. We need $30,900 on hand at the beginning of year 3, at the end of year 2, etc. And at the end of year 4, we're going to be able to close out the project. We're going to recover our net working capital by collecting accounts receivable, by selling off inventory, and by paying our accounts payable. And so the cash flow associated from this is, well, we spend $30,000 at year 0 to get net working capital up to par. And then what we're going to do is we're going to spend another $900 in year 1 and 2. And then in year 3, $955. And then in year 4, we're going to recover all of our net working capital. So we'll have negative $30,000 in the first year, 900, 927, 955. Notice this 900 is the difference in the total net working capital requirement. Many students make the mistake of assuming the cash flow in years 2 and 3 and 4, or 1 and 2 and 3, are the net working capital balances that are required, but that would be wrong. It's not the balances, it's the increases, the investment that you have to make. All right, so those are our cash flows from investment in net working capital. Now, equipment. Our total, we have, I'm going to make it a negative sign. We have $240,000 total in equipment. We have another $30,000 investment because of net working capital, so our total times 0 initial investment is $270,000. All right. Now let's talk about salvage value. Salvage value occurs in year 4, and we're going to receive $25,000 for this piece of equipment. However, you can't just sell a piece of equipment and not have any ramifications from that sale. As far as taxes go, you need to know what the book value is. And in this case, this is a fully depreciated asset because we've got a book value of 0 at that year end. But it could have had a book value of anything if we had sold it before it was fully depreciated. And what we have is we have sold for $25,000. We've had a book value of 0. That means our profit was $25,000 in this case on the sale. We might have had a loss on the sale if we had sold it for less than book value and you'd had a positive book value. But either way, you have to pay tax on that gain. And so the tax on that gain or the tax credit on that loss is the amount of the gain or the loss multiplied by the tax rate. which in this case is 10,000 bucks, and so our net after-tax cash flow is, whoops, I've gone the wrong formula. Our net after-tax cash flow is the amount that you received, the total salvage value, not the gain or the loss, but the total salvage value itself. Turns out those two numbers are the same, but it matters if you have a book value that's not zero, minus the tax that you have to pay. And so at the day is out, you have $15,000 in after-tax cash flows from selling this piece of equipment. All right, so our total free cash flow in year 0 is our total initial investment of $270,000. Our total free cash flow in year 1 is our net operating cash flow plus our cash flow from net operating working capital, which is a negative number, so it's going to reduce it by $900. And in year 4, our total, let's see, you can see everything here. In year 4, our total cash flow is our cash flow from our net operating cash flow plus the recovery of net working capital, $32,000, plus the $15,000 from the after-tax salvage value, and that gives us all of the cash flows that go on a timeline. We can now calculate the net present value of this. All right, our discount rate is, our weighted average cost of capital is 10%. Remember, you have to highlight years 1 to the end and not year 0, because the NPV function always assumes that that initial cash flow is discounted one period. So we want to make sure that the $106,000 is discounted, but the negative $270,000 occurs at the end of year 0. That's right now. It does not get discounted, and so notice that formula has to have the $270,000, in this case B48, outside of the parentheses in the NPV function. And so that gives us a net present value of $88,000. We can now calculate the internal rate of return as well. And in that case, with internal rates of return, you highlight all of the cash flows, 23.9%, and then a modified internal rate of return. We have, again, you highlight all of the cash flows, and we use, in this case, we'll use the weighted average cost of capital as the financing rate and as the reinvestment rate. And that gives us an 18.04% modified internal rate of return. And we are done with the cash flows.